Hello, everyone. Today on the Final Bar, I'm joined by Jeff Hughes from JWH Investments in Minneapolis. We'll talk about this market environment, particularly the prospect of higher rates. Jeff called that the most important chart ever in the history of the planet, or something along those lines. We'll talk about why interest rates are so key. The Fed meeting this week, I think it's just the beginning for 2022, as we've talked about. Today, a lot of choppiness with the S&P finishing in the red, down 0.5%. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market environment using the language of technical analysis, focusing on the message the markets provide back to us. I was taught that the price of a stock, of an ETF, of any asset class tells you the story, or most of the story that you need to know to understand the dynamics of what investors are thinking, what they're feeling, and where they're putting their money to work. We've talked about the importance of some of these key levels. We've focused on the S&P on 4,800, 4,700, 4,550. We sort of keep breaking some of these key support levels. We're down now to arguably some of the real significant ones, 4,300, where we're testing lows from the end of last year. And again, markets overall are doing okay if they're able to hold support. Charts that are unable to hold support really are charts in distribution phase. And I think, for in a lot of ways, a lot of equities are sort of nearing that pattern. We're starting to show some weakness. But today was really sort of a mixed day. We were higher out of the open. By the close, we'd gone below the yesterday's close. But sectors like energy, utilities, consumer staples, now some of those obviously more defensive, but it was not all in the red. It's sort of a mixed bag of things working and things not working. So today is sort of a consolidation feel as we set the stage for what the next move may be. We have a great guest today. I'm excited to have Jeff Hughes join us on the show once again today. Coming up the rest of this week, I'm actually off tomorrow. I'm taking the family up in the Cascade Mountains. We're going to do some snowshoeing and other relaxing winter activities up in the snowy mountains. So Aaron Swellin is from Decision Point is going to take the show for me tomorrow. So thanks to Aaron for doing that. Next week, we have a couple good guests for you. The guys from Go No Go Charts are coming on the show on the 1st. That's on Tuesday. It's Tyler Wood and Alex Cole going to be sharing some of their insights looking at the market environment. Frank Capilleri from Instinet will be on the show next week. Sam Burns from Mill Street Research is coming up soon as well. So we'll keep the knowledgeable guests coming through to help us make sense of things. Also, if you missed our latest episode of The Pitch, we had a lot of fun yesterday trying to record a show in the middle of the Fed conference. We actually recorded it right before the press conference, which was a fascinating look at how to apply technical analysis during uncertain times. But go to stockcharts.com/thepitch to check out that latest episode. Our next segment here is the market recap. Let's talk about what happened today and how today's movements fits into the long-term trends that we've been talking about. The S&P 500 finishing down about 0.5%. That's just above 4325. We're at 4326 and change. The technology heavy and growth heavy NASDAQ pushing down even further with the NASDAQ composite down 1.4%. Mid caps and small caps both underperformed the S&P today, with the S&P small cap index, the S&P 600 down about 2%. By the way, I'm often asked about the S&P 600 versus the Russell 2000 and why you would use one versus the other for small caps. And the general way I would think about this, if you're looking at the Russell 2000, the problem is, think of it as the S&P 600 plus 1,400 other stocks is how I may generally think of it. And a lot of those names are not high quality companies is the problem. So particularly when things deteriorate, you'd most likely see the Russell 2000 struggling because a lot of names in there are not going to survive very well in a challenging market environment. So the S&P 600 are a little more of the stable kind of smaller companies and where they're at. That is a broad generalization. For screening, though, it's always good to use the Russell 2000. It's a broader universe with a lot of potential ideas in here. The VIX actually down a little bit today, still above 30, though, so fairly elevated if you look at the last year as a general frame of reference. Other asset classes here very quickly. Interest rates came off today, really spiked after the Fed meeting yesterday, pushing higher into the close with the 10-year yield finishing yesterday above 185. We came back off today, but rolled higher and finished back above 1.8%. And again, I think that's a very important chart for sure. Well, I'm excited to talk with Jeff Hughes in a little bit about interest rates and what that means for some of the key equity market indicators. The dollar index up almost 1% using the UUP as sort of a proxy for the dollar index. You can look at $USD for the US dollar sort of spot index, but the UUP is an ETF that's fairly liquid and pushing higher today. A little different than the trend we've seen, right? The weaker dollar has been part of the story and why the US market has looked a little less attractive than some of the non-US markets. I was just recording a presentation earlier today for the Latin American technical analysis seminar coming up tomorrow. We talked about Brazil. EWZ is an interesting one. One of my guests on the pitch yesterday included that as one of their top 5 ideas. Gold and silver lower today, really through the course of the day, sold off pretty good in the morning session. So those measures, the precious metals down a little bit. The other side of commodities, particularly energy, up pretty good with oil prices rallying in the energy sector. As I mentioned before, the top performing of the 11 S&P sectors. A lot of red if you look at cryptocurrencies, with Bitcoin down 3%, Ether down 5%. I tend to think about Bitcoin and Ethereum and sort of the broader crypto complex as a fairly pure measure of speculation, and those being down tells me it's sort of a risk-on environment. That's not a perfect correlation. If you go back a couple of years, but particularly recently, you've seen them move in lockstep. And I think the weakness that we've seen in cryptocurrencies over the last couple of months might have sort of led the drawdown that we've seen in stocks. So those continuing to show weakness certainly doesn't make me feel good about the overall risk appetite, particularly for individual investors. Let's look at a chart of the S&P. We often spend some time here. We always talk about some of these shaded areas on the S&P chart. 4,700 was the breakout level from last November and December. Failed and failed to regain that level earlier this month. We then broke through 4,550, which is a well-established resistance level that became a support level in December. We blew right through that without even much of a pause. Continue to push lower. We're now to sort of that last support level that I've illustrated on this chart, the sort of orange shaded area. And this is 4,300 or so. This takes us back to the September, October lows from last fall. I think we're at a key point. The fact that we've traded down to that level a number of times, pretty much every day this week, we've sort of traded down to that area, but have closed back above it. Today, we have a new closing low for the year, and we're really close to breaking 4,300. Not quite doing it today, but I think that continues to be a really important level to pay attention to. I was asked recently about the RSI being oversold, and just like when the RSI is overbought, that on its own does not tell you a top is ready, right? That just tells you we've gone up a lot. The RSI being oversold tells you we've gone down a lot. You want to use other things to understand the dynamics of this market. Could we see a bounce off of oversold levels? Absolutely. But the fact that we're so oversold suggests to me there's certainly plenty of selling pressure, and it's not alleviated just yet. We're seeing lower closes so far through the course of this week. Just to finish off our market recap, I want to look a little bit at the breadth conditions. We're going to do a segment later today's show called Getting Sentimental, where we're focused on the sentiment indicators of interest. But I want to focus a little bit on the breadth conditions because we've talked about breadth deteriorating over the last couple months. I think we're really getting an exclamation point on that breadth deterioration this week. And for me, seeing a confirmation of the negative pattern that we've been building here. The NYSE advanced decline line as of yesterday's close, this is not updated yet for today, this is as of Wednesday's close, made a new low for the last 6 to 8 months. You have the same thing on the small cap AD line. So these have both broken below their lows from December, their lows from last September. This is a new sort of regime, I would argue, for some of those breadth indicators. And it's after you have this sort of broad divergence. The S&P made a new high going into the beginning of this year. The S&P large cap and mid cap breadth lines both made a new high, but the small cap and the NYSE breadth did not. They did not confirm that new high. So you sort of have a breadth non-confirmation that is now starting to show a breakdown. The mid-cap breadth line is really close to breaking down through the December lows that might have broken after the close today. I would assume it has. And then the only one left is the large cap breadth. And if you see that breakdown, it really shows you this rotation. It's not just mega cap names struggling or just a couple growth names. This is a broader distribution that I think could indicate a likelihood of further downside. Also, if we look, only less than 1 in 3 S&P stocks remain above their 50-day moving average. It's not many, and I would probably guess they're mostly in the energy sector. When I'm looking for new highs, it's sort of a lot in energy, a couple financials, and then just peppered around in some of the other sectors. But most names have kind of broken down. Now less than half of the S&P members above their 200-day. And so when I'm asked about how this pullback relates to some of the previous pullbacks that we've gotten very used to in the last year and a half, where the market pulls back, it's an obvious buying opportunity. We ride that to the next highs. We now have less than half of the S&P above their 200-day. That's back, different from when we had 80, 90% of the S&P above their 200-day back here in early 2021. So when we think about that deterioration, that is a broad move where a lot of names are unable to hold their 200-day, just like the S&P 500 is unable to do so. For me, those are conditions that tell me that at the very least, there's an increased likelihood of further downside, and to think about protecting from, protecting against downside risk. We need to take a quick break. We'll be back with today's guest, Jeff Hughes. We'll see you in a minute. Hey, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's great to have you join us every weekday after the close as we focus on the market environment using the power of stock charts, using the technical analysis toolkit to better quantify investor behavior. A couple quick comments before we get to today's guest, Jeff Hughes. First off, we welcome your questions. We have a mailbag segment a couple times a week. Those are all populated with questions that you guys are sending in. The best way to get your questions to us is via email, thefinalbar@stockcharts.com. We're on Twitter @finalbarsctv. We're on YouTube. Put a comment below the video you're watching on our YouTube channel. We'll gather all those questions. Hope to answer your question next mailbag segment on the air. Also, go to StockChartsTV.com. That's our on-demand platform. Special events like The Pitch, our market outlook specials from earlier in January, and also all of our great regular shows with all the fantastic guests on demand for free on our website. Go to StockChartsTV.com, or on your mobile device, just search on any of the app stores for StockCharts TV on demand. I want to welcome on today's guest, Jeff Hughes. Jeff is the founder of JWH Investments, coming to us from Minneapolis. Jeff, it's good to see you. Happy New Year and welcome back to the show.
Thanks, Dave. It's a pleasure to be here.
So I mentioned earlier this week on the show, I described this as an uncertain week, in an uncertain month, in an uncertain year. It feels like there's just so many competing narratives, so many potential movements to try to make sense of. We're starting with your chart of the S&P 500. Talk us through what you're seeing here.
Yeah, Dave, we've seen a pretty steady bull market advance right through the first trading day of the year. And then things started to unwind. It was the 55-day simple moving average that's really kind of held the trend. And despite extremes in valuation, over concentration, and a lot of leverage in the system, that was the silver lining up until about a week ago. And then we really cut right through that 55-day SMA like a hot knife through butter and took out initial support around 4,500, 4,550. And now we are challenging or testing what I would describe as critical support. We've used a 55-week simple moving average to define the intermediate term or longer term trend since last year, or I should say the March 2020 lows. And it's been a pretty good guide for the longer term trend. 4,300 seems to be kind of that critical floor. And even though we've cut through it on an intraday basis, we have held above it since then on a closing basis. What we'd like to see is a weekly close above 4,300 and above that 55-week SMA to give us some confidence that stabilization is resuming in the market.
It's funny because I think recently, Jeff, it feels like we've had really clear support levels, obvious support levels that we've just hit. Now, all of a sudden, when you have to start thinking, all right, now what's next, and go back even further, right? It tells you conditions have certainly started to deteriorate. Now, obviously, leadership was a big question mark last year, and now going into this year, you have energy up while everything else is down. Talk to us about value versus growth.
Yeah, so what we're looking at here is a 15-year monthly representation of the pure value versus pure growth ratio. So when the line is headed south, that means growth is outperforming. And when the line is heading up, that means that value is outperforming. And over the course of the past 2 years, we've seen what appears to be kind of a double bottom base in that ratio developing. And over the course of the last 4 to 6 weeks, we've actually seen that ratio break out above its 36-month exponential moving average, as well as trend resistance. And today, we've actually even penetrated what I would describe as chart resistance. And what we've seen actually on the lower panel is momentum leading the price, the ratio itself. And the breakout that we've already seen in momentum to new highs vis-a-vis its 2021 high gives us a lot of confidence that we should see some carry forward in that value versus growth ratio, which means that investors who are still focused on growth stocks need to reconsider their positioning and adapt to this massive change in the market that's happening underneath the surface of the indexes.
Now, before we started the show, I paraphrased in the intro. You called this one of maybe the most important chart, to pay attention to. Talk us about the about interest rates. This is the 10-year yield here.
Yeah, so I said the most important chart in history, and maybe that's just relative to my career, which began around 1990. But we've been in a bond bull market since 1980-81, so it's about a 40-year bull market in bonds. And this chart seems to suggest that that is behind us. The bull market in bonds is over, and we'll know for certain once this 10-year bond yield takes out the 268 level. That's really the level that 40-year trend line bisects. We're not illustrating it here, but this is an inverted classic pattern base formation of the head and shoulders variety. And it tends to resolve to the upside proportionately to the base or the head portion of that pattern. And if we just use a basic simple count, it gets us to about 3% on the 10-year. Now, since it only took about 9 months to get from 3% down to that neckline last time around, this could happen relatively quickly. They tend to be symmetrical moves. And it wouldn't surprise me if a year from now, we're talking about 3% 10-year bond yields. And that's going to be a wholesale change to the way the market has valued all asset classes, relative to these, perpetual low interest rates that we've observed for the last decade or more.
Yeah, it takes us back to the late 2018 high for the 10-year, which is fascinating. Your last chart here, Jeff, is looking and relating these two. How do we relate the growth versus value versus interest rates?
Yeah, so what you can see here is that there's a very strong correlation between 10-year bond yields and that pure value divided by growth ratio. Again, this is a 15-year monthly look back, and we're using a 20-period correlation measure to determine what the correlation coefficient is. And it comes in a little bit above 80%, 0.81 correlation. So my suggestion would be this: if 10-year bond yields are going to 3% in the next year, then we're going to see a massive rotation out of growth stocks and into value stocks, and it's just beginning.
It's such a great take. And Jeff, you never disappoint bringing long-term charts that make the short-term movements we're seeing make a lot more sense in the long-term picture. Jeff Hughes, thanks so much for coming on the show. Stay safe there in Minneapolis. We'll talk to you again soon.
Thanks, Dave. Always a pleasure.
That's Jeff Hughes. Jeff's the founder of JWH Investments, coming to us from Minneapolis. And I love bringing guys like Jeff on, giving us a sense of the long-term trends. He works with a lot of institutional investors, and these are the trends that they are discussing. That whole rotation, I feel like for a lot of new investors, as Jeff was kind of implying, a lot of newer investors really haven't experienced that extended period where value is working a lot more than growth. We haven't seen an extended period where banks are outperforming big tech stocks. It could certainly happen, and if rates do what we're suggesting there, certainly a likely outcome. Great take there from Jeff Hughes. Let's continue on. Our next segment is called Getting Sentimental. A lot of the weekly sentiment data gets updated Wednesday into Thursday. So Thursday is a really good day to bring up some of the sentiment measures and see what we can draw for that. I'm using my sentiment indicator watch list, by the way. It's a chart list I have on StockCharts.com. Most of the charts, if not all of them that I show on the show here, are all part of the free chart pack. If you're a StockCharts subscriber, you can download all of these to your own login and use them as much as you like. If you ever want to get to them, by the way, go to your dashboard, click on when it says chart lists. You're going to have a list. You probably don't have as many as I, because I have this problem of creating chart lists anytime I get the idea. And at the very bottom of your list, you will get this gray button that says Manage Chart Packs. You'll see mine along with many others that may be worth looking to. Mine's called the David Keller's Morning Coffee Routine Chart Pack, or something along those lines. Let's talk first, when we go to sentiment, let's talk about the VIX. So, the VIX for 2021 was range bound for the most part, between about 15 on the lower end and 20 to 25 on the upper end. A number of times we broke above 20, we got up to around 25, and that was usually it. Now, all of a sudden, we're starting to show in the last couple of months a much more elevated VIX. In November to December, we broke above 25, got up to 30, 31. Right now, we're back just right above those levels again this week. It's starting to feel a lot more like 2020 and a lot less like 2019. 2019 was down in the 10 to 20 range at most. 2020 was obviously a much more elevated VIX as we were digesting the 2020 low and the recovery after that pack. 2021 actually had a VIX that was sort of in the middle, sort of between those two. And I would argue, and when I was doing an outlook for this year with Tom Boley, I mentioned, I think one of my suggestions or predictions is that the VIX will spend more time above 20 than below 20. We're already starting to see that so far in the first couple months of the year 2022, with the VIX getting above 20 and sort of remaining there. Elevated VIX usually coincides with market bottoms, but remember, it's not absolutely bound. It's not like the VIX getting to 25 or 30 means it's over. The VIX can go a lot higher, and that's what we saw in February, March 2020, where it just kept increasing. I think we're in an elevated volatility, elevated uncertainty type of environment. We're certainly seeing that so far. Interesting information this week from the AAII survey. We're actually seeing a continued decline, or a continued increase, I guess, in the spread between bulls and bears. This week, we got over 50% bears, which is actually incredibly unusual. The last time we had this much bearishness was in March of 2020. The first couple of weeks in March was in the middle of this sell-off. We had an extreme bearish reading. We're actually seeing a very similar pattern right now. Before you go getting all excited about, all right, that means we're bottoming out because sentiment is so negative, not necessarily. I'll show you a chart a little later in the show, which maybe dispels that to a degree. Bulls are just up a little bit to around 23%. So it's certainly, it's over a 2-to-1 ratio of bears versus bulls. The spread between the two, again, the last time we were this negative was back in early 2020. And before there, you have to go well before 2017 to find previous examples of where we were this low. So this level of severe bearishness, again, usually comes in one of two scenarios. Either we've had a severe sell-off and that's it, or it's the beginning of something much more deeper and much more painful. And so when I'm hearing Jeff Hughes talk about 4,300 and thinking about some key support levels, the problem is if you break some of those levels, then what? And I think that's the problem you have right now with the bearish sentiment. It's bearish now. What if things get even worse? The name exposure index, by the way, is looking at active money managers, and they can basically say every week how they're positioned in equities: 100 or 200% long, 0% equities, 100, 200% short. Right now, this reading this week is just above 53%. That's down from around 90% just a couple weeks ago, and a couple months ago, going into the November high, it was over 100% long. So you've gone from 105% plus down to 53% net equities. If you look at the blue horizontal line, that shows you our current value relative to some of those previous values. What's interesting and what's a little concerning about this chart right now is if you look back at some of the deeper pullbacks in February, March of 2020, in October, November of 2018, in 2015 and 2016, where you had some deeper drawdowns, you had positioning levels way below here. We were down sort of in the 20-25 range, even down to single digits there in March of 2020. We're back to where we were just at the beginning of the sell-off in February of 2020. We're nowhere near the readings that we got after the market really got bombed out. So what concerns me is even though we're down a lot, that doesn't mean we can't go down even further. And again, there's further downside to be expected if the market deteriorates. That has certainly been the precedent if you look at the sentiment data. The put call ratios, we actually talked about these last week and showed how they were at some pretty extreme levels. What I like to do with the total put call ratio and then the equity put call ratio is look at a 5-day moving average. The daily put call data is actually pretty noisy, and you have a lot of fluctuations on there because it's reported every trading day. I like to do a 5-day moving average because it just smooths out the data a little bit. And when you look at the current level of the 5-day moving average, we're well above what we have been for most of the last 18 months. You have to go back to February of 2020, the last time we got to these levels. Now, at that point, we actually continued much, much higher. You spiked on the put call ratio on one particular day, aggressively higher, but overall, that 5-day average got well above current levels. And again, so what this means is we're sort of different from the garden variety pullbacks that we saw in 2020 and 2021. Those put call levels did not get to this level. We've eclipsed where we were in December, which was the last sort of major buyable pullback in stocks, and certainly well above where we were in September, October of 2021. So now we're starting to look a little bit more like some of the more severe drawdowns in market history. Same thing if you look at equities only. The total put call ratio includes some index options. This is looking just at equities. And again, you can see we're at fairly extreme levels. So sentiment indicators have gone past the normal garden variety pullback. And now we have to look at some of the more bombed out market movements to see how this relates to some of those times. And I think now is a very good time to warm up on your history lesson of some of those market pullbacks. That is our segment, Getting Sentimental. We need to wrap today's show and go to the 3 in 3. 3 charts in 3 minutes. Here we go. Chart number 1, we talked in our market recap about the market breadth conditions. I was asked by one of my premium members at Market Misbehavior, how to think about differentiating this garden variety pullbacks that we've seen since the March 2020 low versus something that's a little deeper. How do you know when things are getting worse? And I would tell you, you can get signals from a lot of different things. I think one of the ways to look at it is when, in a standard pullback, things like Fastenal, which have had pretty good runs and pull back to their 200-day, in a healthy bull market phase and a pullback, stocks pull back to reasonable levels and then make their next leg higher. When they don't hold those support levels, that's when I start to get concerned. When stocks break down and are unable to recover, that's what it tells you from a bottom-up perspective. Things are getting pretty ugly, but you can also roll up those charts into breadth data and looking at the advanced decline lines. I'm concerned by the breakdown we've seen. The AD line on the New York Stock Exchange has made a new 10-month low, which has not happened very often. And that's telling you certainly a strong rotation, not just on a couple names, but a broad universe rotating from a position of strength to a position of weakness. That is one of the things that tells me to be concerned about a higher likelihood for a drawdown here. The AAII survey in our segment, Getting Sentimental, we looked at the last 5 years or so and looked at some of the data here. Now we're going back to 2007, the 2007 market high. And I'm doing that highlighting the current level of where we're at. This is looking at the bearish level of sentiment. If you look back to where we've been this bearish, you are going back to a relatively small number of observations. February, March of 2020, early 2013, which was a bit of a drawdown, but really in the middle of a bull cycle. The 2010 low, a number of times in 2009. So maybe this is just sort of that buyable pullback among others if you look back since the 2009 low. But here's the problem. Go back to the 2007 high and look at what happened to the bearish sentiment after you started to roll over. Look at how often you had over 50% bears. It actually happened a bunch of times, not at the bottom in 2009, but on the way down. And this is what concerns me about this current environment. This also, besides looking like some buyable pullbacks, it also looks a lot like the beginning of really painful parts of market history. Finally, LVS, Las Vegas Sands. We have a lot of earnings this week. We don't have time to get to many of them in a 30-minute show every day, but I'd certainly encourage you to look at charts of Tesla and others to see what they're doing relative to those earnings. LVS is an interesting one. It's gone up to its 200-day moving average, pulling back today. Also, that lines up with the September high and the first Fibonacci retracement level. Potentially some weakness and a mean reversion lower in a stock like LVS. Let's see. Folks, that's our show for today. Special thank you to Jeff Hughes from JWH Investments joining us from Minneapolis. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.